Investments in securities are subject to market risks. Read all related documents carefully before investing.
Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 23rd of May, and the markets were as dull as one could have expected. Although Nifty started with a very nice gap up move, went to almost above 18,400, but then in the latter half of the day gave up all those gains, still managing to close above previous day's close. So nothing lost as such, but the day was lacking momentum, and most sectors were dragging their feet during their day. Uh, Given that there is, headwinds from overseas markets to the extent that the dollar index continues to rise, and there is uncertainty about the debt ceiling issue in the US. Everybody expects it to get cleared by its target date of 2nd of June, but nevertheless, it does stand as a risk to the entire global financial system. What is the debt ceiling debate? We can take it up another day, but essentially, it is a administrative or a legal process where they just have to approve. It's almost like you have a credit card and you've maxed your limit. Now you're asking the company, please give me a 50,000 rupees more on my limit, and if you get the approval, you'll go out and spend more. That's what the US government is doing. Uh, those issues apart, the heat map is very, very clear. It was very mixed with Adani group of stocks again in double digit gains today. Adani Enterprise in 2 days has gone up like 30%. Uh, and Bajaj Finserv was another stock which was doing well. Eicher Motors, uh, uh, on news that a new EV is coming out from Eicher Motors, has been buoyant. Divi's Lab, another day of up move despite poor results. ITC gaining ground after several days, 1% up. But other than that, most sectors and stocks remained flat or down. IT stocks, which had started very strongly this morning, gave up most of the gains by end of the day, following the US futures market there. Metal stocks remained the prime mover in the market, plus 2.6% today, and for the week up 4.7%, the highest so far. Auto stocks also up 0.7% today, and other sectors were neither here nor there, just around the 0% mark, give or take half a percent. IT stocks losing the most at minus 0.5%. Mid caps doing quite well actually, versus any other index. It has now gone and made a new high, and has closed very near 33,000. So mid cap index is showing good buoyancy. Small cap index also retreating from day's top, but still, very well entrenched into this upward trend that we have, and closing at a new high since November or December 22. So nothing lost here on this chart. Also, Nifty Bank has been simmering near the previous all-time high, possibly waiting for Nifty to catch up, or more opportune time once some headwinds are cleared in terms of the US markets. The US dollar index, the one that has gone up from 101 to 103.56 now, is looking strong still. Uh, I was expecting it to collapse below 101, but that did not happen. And until we see a strong down move in the dollar index, I doubt if the markets will see a strong up move. There is a good inverse correlation at times, and the current focus being on the dollar, is suggesting that we need to see the dollar soften before other things start to move up. So today's discussion is about unpredictability of asset classes and why asset allocation is important. So we'll just go through some charts and showcase how different asset classes have performed. Portfolios made up of different asset classes have performed. So this is simply a chart of how US uh, has done versus India. So it is normalized uh, on an index basis. So you can see relatively India outperformed US by a big margin from 2001 to 2010. So US market was virtually flat, and India market really did very well over this decade. Uh, but if you saw this 10-year trend, and let's say some global manager saw this 10-year trend and invested everything in India, uh, in the next 10 years, India, although gained, but the US market gained a lot more. So uh, your past performance of a particular asset class or a particular geography may or may not hold true for the oncoming period. And the idea is that what if you just extrapolate from your prior performance, that itself may not be good enough for having your portfolio to be diversified and asset allocated. So the issue is that most people constantly keep moving to the best performing asset class or strategy. So a lot of folks have very concentrated positions in some assets, and they will see. And the same thing actually happens within asset classes also. So for instance, mutual funds, this is very commonly seen that people will move to the last year's best performing mutual fund, and once they move there, the next year it may be the worst performing what they've chosen, and once they move out, it may again become the best performing. So it can happen like that. And allocation or diversification, it takes a back seat because of this uh, intention to remain with the best recent performance. um, However, if you are well diversified, if you have good asset allocation, and you know that each vehicle that you have chosen will perform in due course in its time because of its inherent uh, properties. So, whether it is a real estate cycle over a very long period, whether it's a gold cycle over a long period, whether it is debt, whether it is equities with a manager who has performed well in the past, and there is no reason for you to, doubt how he or she will perform in the future. So, two cases. Usually, what happens is that in times of extreme distress, that is where these asset allocations or diversifications really matter. Because if we just see point to point over 20 years, equity and maybe some type of equity will always outperform everything else. But the whole purpose of diversification and asset allocation is that your journey from point A to point B also be in such a way that you are comfortable during that journey. It is very easy to see on the chart, a 20-year chart, I should have bought here and I should have sold here, so my life would have been great. But the journey of that person who went through that 20-year period could have been very, very different. And whether that investor was able to sustain through that journey or not is also. So this chart is from the GFC 2008. So the green line here is 100% equity curve. So anybody who invested 100% in equity from January 8 to January 9 went from 100 to 48.5, so more than a 50% drop. The orange line here is a 60% equity, 20% gold, 20% debt. Uh, you would have gone from 100 to 70.99. So versus a 51% drop in the first case, you had a 29% odd drop here in this case. And in the third case, where you had 40% equity, 30% gold, 30% debt, you went from 100 to 84.6. So which was for somebody who may be extra conservative, very very palatable, and not something that would have bothered so much to the investor as a 51%. So again, it depends upon your makeup, what kind of drawdowns you can handle in your situation. Another case was the recent COVID case. So if we look at 100% equity, you went from 100 to about 60, so about a 40% drop, and then from 40 you went to 109. So overall, from point A to point B, you did very well over that crisis. You made 9.4%, but you also had to see a more than a real 40% drop in your equity curve. The next case was 60% equity, 20% gold, 20% debt. Here you saw at the bottom, but at the end of the this period, you ended up even better than the equity first case where you had 100% equity. So this diversification and strategy worked tremendously by keeping you uh, not only safer in terms of drawdown, but also the returns at the end of it. And the third case here is having 40% equity, 30% gold, 30% debt, and you more smoothly just kept going down, but you lost this entire move of equity because you were only 40% into equity. You went from 100 to 84. So over this year you lost about 15%, with the max being 25%. So what we can make out from here is that depending upon your personality and depending upon how safe or how aggressive you want to play the markets, because see, one thing is there, that because the Indian market has continuously gone up in the last 3, 4, 5 decades, we are very used to the fact that the equity market should go up. And there is no reason to also not believe that the equity market in India will continue to go up because of the inherent growth that is available to us, and the runway of the Indian economy that is available to us. But in 5 years, 10 years, 15 years, 20 years, who knows what kind of a world we are living in, what kind of a political setup we may have in the country, what kind of economy may continue to be robust or not, uh, or some other kind of pressures of some religious fanaticism may take over, or something, anything that you can imagine that can rock the boat. You cannot rule that out. So if a sane investor who wants to safeguard his hard earned money would play with some asset allocation, because it is a sort of a 100% blind call to say that the stocks will keep on going up. It may so happen that the stocks may go up Nifty may go up 5x in, let's say, a period of 5 years. It is not unimaginable. Japan did that from 89 to 90, 85 to 90. Nikkei index went up 4x within 5 years. Whether any other country can repeat that or not, I don't know. But they had a 25-year drawdown after that. So what if next 5 years, Nifty goes from 18,000 to 100,000, and then for the next 20 years it doesn't go anywhere up? It can happen. So you need to plan out that what if this happens, where, how will I allocate, how will I exit? All those plans need to be in place. So, my suggestion and my recommendation always is that one should look at asset allocation with a more serious view. And as you mature and grow in your portfolio size and your age and understanding, you would want to protect somewhat what you've already made. Uh, so, this is all I had for today's session. Thank you so much for watching this, and I'll see you in the next one.